We have seen some massive market crashes in the last 2 decades, the stock market crash 2008 and now the market crash due to the pandemic of 2020. Investors who endured in these difficult times and stayed invested were the ones who got the best returns. We should accept the fact that the market crash and economic slowdown would never go away, but we must always stay consistent in our investment and do not allow our emotions to come into play while investing. The reason being, after every dark night, there's a brighter day waiting for you. We have seen this after every decline in history, no matter how severe they may be, investors have recovered their losses and market have seen positive growth over the long term. At these times you must not forget the quote of the famous investor Warren Buffett, which says, "Be fearful when others are greedy and greedy when others are fearful." These times can be great opportunities to buy more at low prices rather selling your stocks at loss. Let us look at some of the reasons why long-term investors should never sell stocks in a panic. Why not sell in a panic? Investors plan their investments for their retirement or their financial goals. This wealth generation starts by investing regularly and with the effect power of compounding coming into play. The most common reason for panic selling is mistrust. At this time one should always remember that market is cyclical in nature. Read more on market cycles here. Nobody can prevent the movement of stocks, but a downturn is always temporary. In this situation, one should think like a long-term investor who knows that the market and the economy will recover. Even during this pandemic, BSE Sensex went down up to 25,981.24 on the 23rd of March 2020, its all-time low, and now in the month of September 2020, it have recovered back to the same position where it was in the month of September 2019. The effective power of compounding. Compounding is nothing but the interest earned when interest payments are reinvested, particularly in the context of stocks. The idea is to stay invested as much as possible. Frequent selling or buying or selling the stocks in panic would not help to grow your wealth. The margin of safety. Margin of safety is a principle of investing in which an investor only purchases securities when their market price is significantly below their intrinsic value. In simple terms, when the market price of a security is significantly below your estimation of its intrinsic value, this difference is called the margin of safety. Long-term investors should buy the stocks as per the margin of safety. This gives them the safety in accordance with their own risk preference. If you're invested for the long term, avoiding one completely will probably be impossible. But no matter when the next one happens, implementing these 4 lessons can help make sure you come out on 2. 1. Timing the market can cost you money whether you're selling investments or buying new ones. Timing the market can cost you if you don't guess correctly. If you sell stocks thinking that there will be a long-lasting decline, a quick recovery could be missed. Many investors and investing gurus believed that the losses experienced in March 2020 because of COVID-19 fears were just the beginning. If you were someone who sold out of your stocks to get ahead of these losses, you could have missed a V-shaped recovery followed by a year of positive stock performance. How much would have depended on how long your accounts stayed uninvested. Between January 2, 2020 and March 23, 2020, the S&P 500 declined from 3,245 to 2,237 and lost 31% of its value. Within 4 months of March lows, this index was in slightly positive territory and closed at 3,257 on June 21, 2020. By year-end, it closed at 3,732, 15% higher than where it started. If you were someone who kept cash uninvested during this same time period because you were fearful of further declines, you would have missed out on 45% worth of gains from the market bottom to the end of year close. 2. Emergency funds are crucial if you've invested money that you could potentially need soon. A decline in value could be a threat to your livelihood. One way you can solve this issue is by making sure you have an adequate emergency fund, one that will get you through a period of lost income. A good emergency fund should cover at least 6 months of your monthly expenses. But the coronavirus pandemic has taught us that you might need them covered for even longer. If you have extra money that you can spare, you can build your emergency fund with these savings. If your budget needs to be reworked so that you can meet this objective, there are several ways you can accomplish it. You can temporarily direct money from another savings goal into it, or you can eliminate unnecessary expenses until this account has a balance that you believe is sufficient. 3. Market corrections can be great opportunities if you are in a financially stable position. A bear market can be a great investment opportunity. If you have a lump sum of money, you can buy your holdings for less when the prices drop. If you feel uncomfortable about putting a large amount of money in not knowing if the stock market could decline further, you can use a dollar cost averaging strategy during this period of uncertainty. With this method, you'll invest a predetermined amount of money into your portfolio each month. You'll get some prices that are higher, and some that are lower. You'll also get the peace of mind that you're not making a big investment decision at the wrong time while getting off the sidelines and investing for your future. 4. Asset allocation and diversification can help you avoid losses. The more concentrated you are in a particular stock, sector, or asset class, the more your accounts could lose from year to year. For example, real estate lost 9% in 2020. If you had an overweight position in this category, you could have ended the year in the red. Investment-grade bonds earned 7.5%. If you moved all of your money to this asset class so that you could avoid stock market losses, you would have underperformed large-cap stocks, which finished out the year at 18.4%. Although the year played out this way, it could have gone differently. If experts had been right and stocks had performed badly, owning bonds and real estate could have worked out in your favor. Because you don't know what will do well and what won't, diversifying and owning a little bit of everything can help you avoid this guessing game. When you invest, there will be some years that your accounts grow, some when they end up flat, and some when you lose money. As great as avoiding losses altogether would be, it's probably not realistic. And attempts at avoiding them might come at the cost of missing out on positive returns as well. Instead, adopting an investment philosophy that limits your losses during these times and lets you capture some of the benefits could make you an even more successful investor. In summary, by picking the right strategy of following the margin of safety, good research and discipline in investing, one can easily beat these market fluctuations and can create a huge wealth in long term. And if you have a long-term investment strategy, you'll be far less likely to follow the panicking herd over the cliff and will keep your emotions at bay during these situations. Instead of fear-based selling, one should use a bear market as an opportunity to buy more, accumulate shares at deep discounts and allow yourself to diversify, building a more stable base for when things eventually do turn around.